Good evening. My name is Jackie Knight. I'm the Corporate Training Director for STC, and I'm glad to have you join me this evening for our educational webinar. This is going to cover a little bit of advanced topics, perhaps, to self-directed retirement accounts, so that I hope it is very interesting to you. Before we get started, just a couple of items about STC. We are a retirement plan administrator, so we do not provide legal, tax, or investment advice. We also don't represent or sell any investments, any securities. We are not a registered investment advisor, and we don't represent or endorse any investment opportunities. I will be talking about some possibilities, but of course, you are the owner of your retirement account, so you will be making the decisions on what you would like to own in your retirement account. We do recommend that you consult with your legal, tax, and investment advisors prior to making any investments. Now, this evening's webinar is going to cover some basic information about self-directed retirement accounts. It is often a new topic to people who are unfamiliar with self-direction. I'm going to talk about some specifics of different types of accounts that may be helpful to you. Talk a little bit about Roth conversions and why you may want to consider one. We're going to go into some detail on non-recourse loans because we oftentimes have folks who are interested in real estate investing in their retirement accounts, but have insufficient funds to fully fund that type of an asset. So we're going to talk about non-recourse loans. We're also going to talk a bit about UBIT and UDFI, some taxes that can, on rare occasions, come into play with a self-directed retirement account. I am going to review the structure and the setup that we use for each of our clients' accounts and why we use that type of account. Then I will go through all the services that we offer and open the floor for your questions. So first, just to quickly summarize, what is a self-directed retirement account? When you have a truly self-directed account, it means that you're working with a company that permits you to choose any type of asset that is allowed by law. Now, you can have a retirement account with a bank or an investment company, and they may offer you a wide range of assets, but oftentimes they are simply stocks, bonds, mutual funds, EFTs, those kinds of things. But you certainly can hold other types of investments, some things that some would consider non-traditional, like real estate, loans, tax liens. Those are all permissible assets in a retirement account. Self-direction also means that you are going to manage your investments. You're going to make the decisions related to the investments that you hold in a self-directed account. So, for example, if you decide you do want to own real estate and you want to have that be an asset that you rent, that your retirement account earns rental income, perhaps appreciation over time, down the road sell the asset possibly, you're going to make all of the decisions that relate to the ownership of that piece of real estate. If you're going to renovate anything, put on a new roof, put in new furniture for your renters, what the rental rate will be, selecting renters, and then if at some point you want to sell the property, what the sales price would be. So you're going to be able to manage this investment in your retirement account just like you would a real estate investment that you might own personally. And so kind of the bottom line with a self-directed retirement account is you have more control. You have a wider range of assets. You have more decision-making ability in a self-directed account rather than just whether or not I'm going to own this stock or bond or mutual fund. Now, why might you want to self-direct? Well, the first reason is a very valid one, and that is that you can truly diversify the types of assets that you're holding. You're not really stuck in the stock market per se. You can own real estate, as I mentioned, mortgages and notes, private businesses. You can own certain precious metals. So you really can diversify into different types of assets, which most financial planners think is a very good thing, to diversify your investment portfolio. And again, that control that I mentioned, you have more decision-making control. You do have the ability to use leverage. Now, we're going to talk more about this. If you're interested in a real estate investment and you can't fully fund it, your retirement account can get a loan. It's not you personally getting a loan, it's your retirement account. But you don't have to fully fund an investment in real estate. So that is a nice advantage. You can use other people's money to fund an investment that you can earn on. So you do have that ability to use leverage. It must be non-recourse leverage, and I'll talk a little bit more about that and define that for you on a later slide. But before we get there, let's just talk kind of briefly about different types of retirement plans. Some of these may be familiar to you. I'm bringing out onto your screen traditional IRA and Roth IRA. I personally have a Roth IRA. These are individual retirement accounts or arrangements. You can make contributions to your traditional and Roth IRAs, or I should say traditional or Roth IRAs, from your earned income each year. Now, for 2023, the income contribution allowances, the maximum contributions have increased. So in 2023, for earnings in 2023, you can contribute $6,500 plus $1,000 catch-up contribution if you're 50 years or older for a maximum of $7,500. Now, in this year, for 2022 earnings, it was $6,000 and $1,000 catch-up, so a maximum of $7,000. So it did increase $500. The catch-up didn't increase. The actual regular contribution increased to $6,500. So just something to keep in mind. Now, a Roth, I do want to explain the difference between these two, because even though they have the same contribution allowance maximum each year, there is a significant difference. Contributions made into a traditional IRA are pre-tax. In other words, when you make, let's just say you made a $7,000 contribution into your traditional IRA, that would be deducted on your tax return, and you wouldn't be paying taxes on that contribution this year for 2022. Instead, when you begin taking qualified distributions from that account, those distributions would be included in your taxable earnings for that tax year. The Roth account is different. Your contributions are post-tax. You do pay taxes on your contributions. So I contributed $7,000 to my Roth IRA. It did not get deducted from my income for taxes for 2022. However, when I begin taking qualified distributions from my Roth, those monies are not going to be included in my taxable income at that point in time when it's a qualified distribution. So that means as I have an investment in my Roth IRA that's earning about 7% a year, compounding. So all of those earnings that my Roth account has been earning over the years will, when I take them as distributions, actually be tax-free if it's qualified distribution. So a Roth account earnings can be tax-free. So just something to keep in mind if that might be of interest to you. The next two, well, I'll go with a SEP. A SEP is a simplified employee pension plan. Contribution amounts have increased for that as well. A SEP is often a plan used by a small business owner, maybe with employee and employer contributions can be made. Sole proprietors can actually have a SEP as well. I have a SEP. So I'm the owner and the worker, so I can make contributions into the SEP that way. You do have larger contributions because the contributions are actually from the business that the SEP is on. And for 2023, your maximum contribution, I think there's also a catch-up, but $66,000. So that did increase for 2023 as well. And that's from earnings from the business that the SEP plan is on. A simple plan, savings incentive match plan. I know of a couple of limited partnerships that use this type of plan. I think a sole proprietor can also use it. You'll want to check with your tax advisor on all of these details. But it is a savings incentive match plan, and its contribution amounts went up as well for 2023, 15,500 plus a catch-up for a total amount if you're 50 or older of 19,000. So just some opportunities to contribute some more funds. Now, I just brought out on your slide 4 different types of plans that say former employer. So a 401k is a for-profit company, corporate type of plan. 403bs, often used by charitable organizations, nonprofits. TSA, tax-sheltered annuities, and TSP, thrift savings plan. TSP, federal government, can be that type of a plan. So different employers, types of plans. Now, if you formerly worked and participated in one of these plans, you can move the money, if you haven't, move it out of that plan into another plan that you qualify for, say a SEP, if you qualify for that, or a traditional IRA. And then you could self-direct those monies. Now, if you are currently employed and participating in one of those plans, you will need to check with your plan administrator to see if you are eligible to move money out. Some plan documents are written that if you brought money in from another employer into your current employer's plan, you can take it out. Some plan documents are written that if you've reached a certain age, you can take some of the money out. So it will definitely you have to go to your plan administrator to find out what your company's or your employer's documents say if you want to move money out. One more type of plan, solo 401k. This is newer, but now it's been around quite a while now. This was set up by the IRS for sole proprietors, basically, to give them the same advantage, the same kind of retirement earning power as a corporate plan. So solo 401k, got to be a sole proprietor, very limited employees, if any. You could be in the business with a spouse, but it does give you some nice benefits. You can make both an employer and an employee contribution into a solo 401k. This is a plan that is based on your business that you are in. And it does have a Roth provision, so that's nice. You could make contributions that could earn tax-free. And it also does have a loan provision that is nice. Sometimes small business owners need to take money out for whatever purpose. And so that's a nice provision of a solo 401k. So keep that in mind. If you are interested in a solo 401k, I can certainly send you more details and talk with you about that. But you should know that in order to make a contribution for 2023 into a solo 401k, you have to have that plan set up and open by December 31st. So if you have your own business, working for yourself, want to set up a retirement plan for your business, you do want to get those documents in place if you want a solo 401k. Okay, so that is some information about different types of retirement accounts. Now, I do want to talk about, just briefly about moving money between different types of accounts, rollover, portability, and consolidation. There are 2 different types of accounts. There's pre-tax and post-tax accounts. So you can move money from an IRA, a traditional IRA, into a SEP account, and from a SEP account into an IRA. So let's say you have had a traditional IRA, you worked in corporate America, you retired, now you have your own business, you set up a SEP for your business, a retirement plan for your business. If you wanted to move those funds from your IRA into your SEP, you could do that. They are the same type of money. They're both pre-tax contributions. And the reverse is true too. If you have a business, you have a SEP plan on it, and now maybe you're retiring, you're going to sell that business, close up shop, you can move the money from that SEP account into an IRA if you wanted to. Same kind of funds, so you can move them back and forth. And that also gives you the opportunity to consolidate. I have known people who have had several traditional IRA accounts, like with different companies. So they've got sometimes little pots of money in different places. You can put all of that money into a single traditional IRA that might give you more purchasing power. Now, you can also put IRA money, SEP money, and simple money into a Roth. But you notice I have a little asterisk there. And the reason is because a Roth account is post-tax, and you didn't pay taxes on any contributions into your IRA or your SEP or your simple. If you convert any monies from those types of accounts into a Roth, then there will be a tax consequence. We'll talk more about that, but just keep that in mind. You can consolidate like accounts and there's no tax consequence, but if you're moving from a pre-tax type of account to a post-tax, then you will have a tax consequence. Now, I've already discussed, I think, most of these contribution limits. Yes, I've already mentioned traditional and Roth. These are 2023 limits. One more thing to mention here is required minimum distribution, commonly called an RMD. With most accounts, you are required to take a minimum distribution when you reach a certain age. That age has gone up this year in 2022. It was 72. When you reach the age of 72, you were required to take a minimum distribution. In 2023, that age has gone up to 73. Now, that means that if you own accounts that require a distribution, like an IRA or a SEP plan, you are required to take money out of the plan, and there is a penalty if you don't take money out. So it's that distribution is calculated based on the fair market value at the end of the year, so December 31st, 2022, if you were required to take a distribution this year. And there's this formula that it's calculated. Now, a Roth account does not have required minimum distributions. So that is another advantage of it. If you don't need the money in your Roth account and you'd like to just leave it there and keep it earning, and maybe you don't need it, maybe you want your beneficiaries to get that money, you're not required to take a minimum distribution from a Roth account at this point in time. So another maybe perhaps nice benefit of a Roth account. Now, just to mention a few other things, if you take an early distribution from an account, so if you receive a payment, for these terms, retirement age to take a qualified distribution is age 59 and a half. If you take a distribution from your retirement account prior to that, you could have a penalty. Usually 10% additional tax penalty. Now there have been some exceptions in recent years with the Secure Act, so I'm going to refer you to your tax provider or your tax accountant if you need a definitive, if you need to take a distribution and you're not 59 and a half, you can figure out if you qualify for one of these that won't incur a penalty. So there may be some exceptions. If you do have to pay the additional, it is a 10% tax. Distributions are reported to the IRS. Now, if you are taking a Roth distribution and it's an early distribution, then the amount of that distribution that can be attributable to your contributions. So your accountant will be able to help you determine what that is, but you put in a percentage and then you earned a percentage. So you would be able to figure out what percentage of my distribution is attributable to my contributions. Remember, you already paid taxes on your contribution, so you don't have to pay taxes on those again. So that's just something to keep in mind. That would be a calculation that would need to be done. So just a little bit more about Roth accounts. I have had a lot of interest in these over the years that I've been talking about retirement accounts. The advantages, again, that tax-free growth opportunity. So my investment that's earning 7% every month, I get 7%. I have it reinvested. So every year I'm getting 7% compounded on my Roth. And when I take qualified distributions, which I'm already eligible to do, I will not have to include those in my earnings and pay taxes on them. So that's a lovely thing. Now, there is a 5-year holding or 60-month holding requirement. So if you opened an account today and funded it, before you could take a qualified distribution and not pay taxes on it, you would have to have a 5-year holding period. So you do want to keep that in mind. Now, there are income limitations as to who can open a Roth account. However, there are some opportunities to make a contribution into a traditional account, traditional IRA, and then convert it to a Roth IRA and pay the taxes, and then have that tax-free growth potential. So that would be a conversion. If you, and again, talk to your tax person, they'll be able to help you determine that, but we do have some clients that have done that in order to get funds into a Roth account. Now, just a little bit about conversions. Let me link it to that 5-year holding requirement. I know of people who have lump sum, a big amount of money, say in a traditional IRA, and they want to put it into a Roth account. And they know they'll have to pay taxes on those. So they might do part of their conversion this year, and then part of it next year, and part of it the following year. And you certainly can do that. But one thing to keep in mind, that if you do convert lump sums, that 5-year holding requirement is going to apply to each conversion amount. So let's say you put $10,000 in this year, you converted it, then your 5-year period starts counting this year. Next year, you put in another 10,000, you convert another 10,000. The 5-year period for that 10,000 starts when you put that money in. So again, you will need some assistance in keeping track of those things with your tax account. But it does have some advantages, of course, that tax-free growth. As I mentioned, if you convert monies from a traditional, say, to a Roth, there will be taxes due and payable. If those taxes are paid from the converted account, then that could be viewed as it will be viewed as a distribution. So you do want to talk with your tax preparer about how you're going to pay those taxes, and make sure that you are. It could, if you're not 59 and a half, it could be an early distribution, and you could incur a penalty on it. So just keep that in mind. Again, if you have multiple accounts, you can convert part of them, all of them, one of them. So you can do partial account conversions. And just the bottom line is there are a lot of nuances to this. And if you feel that tax-free growth opportunity is valuable to you, then you may want to look into this and check into this with your tax guy. Okay, so now let's move on to another topic that relates to real estate investing and using leverage to do that. So back again to what I said earlier, your retirement account can get a loan to purchase a realty in your retirement account, but it must be a non-recourse loan. So what is a non-recourse loan? It simply means that the security instruments, the notes, mortgage, they don't allow any recourse against you, the individual account holder, or the balance of the funds in your retirement account if there's a default or foreclosure on this loan property. The property itself is the only source of repayment. So it's going to be more like a commercial loan. And I'll give you some of the general specifications for this type of a loan. There's no income employment verification, as there is in a personal loan, because this is your retirement account actually getting the loan. So your retirement account doesn't have a job. So that is unnecessary. Just general industry standards. Again, you would go out and do your due diligence and talk with different non-recourse lenders and find out what their specific terms are. But generally, required documentation, of course, a loan application. They'll want to see a purchase and sale contract for the property. They'll want to see a statement of your IRA account or whatever type of retirement account you have, appraisal of the property. If it's a rental property and there's previous tenants, they're going to want to see a rent roll. So that's pretty much standard documentation that's required. Now, loan guidelines. The maximum loan to value that we've seen is 70%. So you are going to have to be putting down a larger down payment than you would on a personally guaranteed loan. So 30% minimum or more. Oh, excuse me. Maximum term, 20 to 30 years, could be that long. We've also seen adjustable rate mortgages, 3-1, 5-1, 7-1. They're also going to be, the lender is probably going to have want to see an income to expense ratio of 1.25. So going to want to see that is going to be how much you're going to be earning to the expenses your property is going to incur. And they will very likely require you to hold some money in reserve in your retirement account. Oftentimes it's 3 to 6 months of expenses. So let me just explain why that is. Let's say you own a rental property. You're going to have debt if you're getting this non-recourse loan. So you're going to have to be able to pay principal and interest, and that's going to have to be paid from your retirement account because that's who the borrower is. And let's say you need to have you're going to have to pay taxes on this, real estate taxes, because you own your retirement account owns a property. If you have storm damage, you have to pay insurance. All of those need to come out of your retirement account, any costs related to this property. So the lender is going to want you to have some money in reserve to cover those costs, because the only other way you can get money into your retirement account is earnings from your assets that are already there and contributions. And since earnings are kind of an unknown thing, contributions are limited. So the lender's going to want to see reserves in your, some kind of reserve funds held in your retirement account. And what that amount is will probably be determined by the lender and by the type of property. Eligible properties, single family residences, certain condos, you would have to check with the lender on that. 2 to 4-plex buildings, multifamily units, so 5 or more, like small apartment houses, retail, office, warehouse, all of those are eligible for non-recourse loans. Here are some of the things that are not. Mobile homes, timeshares, and condo hotels. Condo hotels has become a big thing more recently. Certain restaurants, dependent again on the lender. Residences with 5 or more acres and farms are generally ineligible. So again, when you are talking with your lender, you're looking at lenders, you'll want to find out their specific requirements. Now, I want to go on from owning real estate to a couple of possible tax consequences. The first one is unrelated business taxable income. So let me define what that is. It's called UBIT, unrelated business income tax, or unrelated business taxable income. It was designed by the IRS so that charitable organizations who didn't pay taxes wouldn't have a benefit over for-profit organizations who do pay taxes if that charitable organization had some income producing part of their business that wasn't tied to their tax exempt status. So So they have to, on those types of incomes that not related to their tax exempt status, they do have to pay taxes. They have to pay UBIT. So an example might be a public university that is a nonprofit, but it rents out its, I don't know, stadium. It's got a concert hall for a rock concert that earns money. Rock concerts are not part of their tax exempt purpose, generally speaking. So the revenue that they earned could be considered UBIT. So that's just a kind of a far out example. But the IRS also decided that they've ruled that it can also apply to certain types of income that are generated in your IRA, because your IRA is not taxed until you begin taking distributions. And with Roth, it's not taxed on those distributions. So let me just now say, to relieve your conscience, your worry, in most cases, the majority of cases, the net income that your IRA generates is exempt from UBIT. Typically, your IRA investments are generating passive income, interest income, rental income, dividends, distributions. Now, if you're a real estate investor and you are in your retirement account purchasing real estate, maybe you're renovating it, renting it, selling it, buying another one, doing the same thing, that sale of real estate generally would be considered passive as long as the intention of that purchase was for appreciation or long-term gain. There are some instances, if you did that many, many times in your retirement account, where the in a single year, where the IRS might consider that you are doing a business inside of your retirement account. So you will need to discuss that with your tax advisor also, just to make sure that your retirement account isn't incurring UBIT because it looks like you're operating a real estate investing business inside your retirement account. So just something to think about if you're interested in real estate. Now, a subset of UBIT is unrelated debt finance income, which is taxable, UDFI. Now, this applies to income that's generated from an asset that was purchased using financing. So first, let me say, if your retirement account has purchased an asset and fully funded it, you didn't get a loan, you bought it outright from funds in your retirement portfolio, then this doesn't apply. If you got a loan, if your retirement account got a loan to purchase this asset, then this will apply. It applies to income generated from an asset that was purchased using financing. And it's based on any income that that property earns. So if it's a rental property, rental income. It is based on the net income of the property. So you can deduct all of the expenses related to the property from the earnings to calculate what you're going to have to pay taxes on. The first $1,000 of the net income is exempt from the tax. Then the tax is calculated based on the percentage of that, what's left after that $1,000. The amount of that is taxable is based on the ratio of debt on the property. So let me just give you a general example. If you financed 50% of a real estate purchase, then, and let's just say you earned $50,000, and it was a 50% debt financed property. $50,000, let's say you earned $51,000. Okay, the first $1,000 is tax exempt. Then the $50,000, only 50% of that is debt finance. So only 50% of that is going to be subject to UDFI. So it is based on the percentage the ratio of debt on the property. Now, when it comes time to sell the property, if you want to do that, if there was any debt in the previous 12 months on this property, then if you have a gain, that is also going to be subject to UDFI. Now, at this point in time, at the sale of the property, the calculation is going to change, and it's going to be based on the debt in relation to the sale price. Now, keep in mind, your debt has gone down as you've been paying off this property, and the sales price is going to be different than what you paid. So just keep in mind that that will be a new calculation, but a percentage of your gain will be taxable. So you do want to keep that in mind. Now, just a note that is something you might want to keep in the back of your mind if you're a sole proprietor. If you are using a solo 401k plan, UDFI does not apply. So just something to think about. If you're a real estate investor and you want to set up a solo 401k on your real estate investing in a business, this might be something that you want to consider, think about. Now, I have talked to people who say, no, it's too complicated. I don't want to and I don't want my retirement account to have to pay any taxes. And I understand that thinking, but let's just take a look at an example, just in case as you're thinking through this possibility of real estate investing and using leverage, maybe if you look at the numbers, it might be something you want to do, even though you have to pay taxes. So let's just do a little example here. There's going to be a rental property. So you bought something, you 50% debt financed it. So we'll just say it was, I don't know, $500,000. You probably wouldn't pay that much for rental. $500,000. You got a loan for $250,000 and you paid $250,000. Okay, so it's 50% debt financed. Now, your annual net rental income is $12,000. So that means all of your rents came in and all of your expenses were paid. Your taxes, the new roof, whatever you paid for the renter and utilities, any of those things, they're all deducted. And your net rental income for the year is $12,000 a month. The income that would be subject to the UDFI tax is $5,000. Remember I said the first, you would take $6,000, that's half of it because it's 50% debt finance. So $6,000 is subject to the tax, and $1,000 of it is tax exempt, the first $1,000. So now we've come down to $5,000 is subject to UDFI. Now, the IRS has decided that the trust tax rate is the rate that your retirement account will be charged. And the 2023 trust tax rate percentages didn't change from last year. They're 10%, it's a graduated tax, 10% up to 37%. But the cutoffs for each level did change slightly, so actually a little bit to your benefit. So the actual calculation for this, I did this for this $5,000, the taxes would be $794. So your net income after paying that tax would be $11,206. So I go through this process so that you can see maybe it's worthwhile to pay $794 in order to earn $11,206, however, whatever your numbers would be. So you may want to do this kind of an analysis if you are considering leverage and just thinking about that. Something else to keep in mind is that this is reported on IRS Form 990T, taxable 990, and it is taxable at the trust tax rate. And of course, discuss it with your tax advisor. Do keep in mind that the taxes must be paid from the retirement account because that's who owes the taxes, the retirement account. And of course, you have $12,000 that you earned in there to pay those $794 in taxes. So you do want to keep in mind that it is your retirement account that will be submitting the 990T and will be paying taxes. Now, enough about taxes and such, let's talk about how STC helps our clients with their self-directed investing. One of the things that we do for each of our clients' accounts is we set up an LLC structure that becomes the investing vehicle for your retirement account. And we do this because it gives you a great deal of flexibility in structuring transactions. You can do some very complex things with an LLC structure. You can have multiple parties to an investment. You could have, and also have debt leverage. You could have one of the parties actually be maybe working on the property, as long as they're not a disqualified person, which we didn't talk about in this webinar, but so you can really do a lot of complex transactions using an LLC structure. It is not a generic business LLC. It is a specialized LLC that we set up for your account. Its operating agreement and its articles of incorporation are designed for it to be owned by a retirement account. So it is a very specialized LLC, but it is an LLC, a limited liability company. So it does provide an additional layer of asset protection. One of the really nice things about it is it does give you checkbook control over your retirement funds. We know that good investments, they can come and go really quickly, and sometimes you need to be able to move on them right away. So having checkbook control permits you to do that. Now, you'll notice I have checkbook control in quotes, and that is because we don't actually give the checkbook for the retirement account to our clients. You could get yourself into a difficulty doing that if you engage in a prohibited transaction unknowingly. There can be some severe penalties for that, even up to forfeiting your retirement account and it becoming immediately taxable to you. So what we do instead is we review your transactions. The same day that you send the documents to us, we look at them, and if there's no question about the investment, we can same day fund that, or next business day if it's after our 2 p.m. bank cutoff, we can fund that investment for you immediately. So basically, you have protected checkbook control. You have our experts looking over your transaction, making sure that you're not violating any of the rules related to your retirement account. It does simplify asset titling. For example, if you were buying real estate, you could actually go to the real estate closing on behalf of your retirement account and sign the closing documents. I have spoken to at least one person, probably more, who had a real difficulty with a real estate transaction. They were with another company, and they had to send these closing documents into their corporate office, and whoever got them was on vacation. So that won't happen with us because you can go to closing on behalf of your retirement account with this LLC. It does also make it easy to pool or partner with other funding sources. So let's just take a kind of a quick look at how that might be. I have here partnering with yourself, your spouse, family members. Now, if you know anything about partnering with others, there is something called a disqualified person rule. It's a prohibited transaction to do a direct transaction with a disqualified person. And you, your spouse, and certain family members are disqualified persons to your retirement account. However, using our LLC structure, and if the transaction is structured properly, you can partner with personal funds, with your spouse's retirement account, with your father, mother, son, daughter. Those would otherwise be disqualified persons, but I'm going to show you on the next slide at what point in time partnership works. You can also partner with other investing colleagues that aren't related to you in any way. LLCs could be a partnership of an LLC, investment syndications. But this disqualified person rule still does apply, so you do have to be careful in structuring these transactions properly. So let's just look at a little schematic here. And I can see my time is getting, okay, I'm almost done. On the upper left, you'll see current custodian. This would be where you're holding your money now. And you decide you're going to work with FTC, so you would transfer or roll over funds to our self-directed custodian. We would set up the retirement plan LLC in the state of your choice. Once the money was at our custodian and then moved to the bank account that your LLC has access to, you're ready to begin investing. And in this case, you have invested, your retirement account has invested in a tax lien, some gold bullion, and you are one of 4 co-owners in investment number 3, which is foreclosed real estate. Now, notice I've got father, daughter, personal funds, and your retirement account. Normally, these 3 parties are disqualified persons to your retirement account. But notice this yellow box. As long as you co-invest at the inception of the purchase transaction, this is a permissible transaction. So if you're interested in doing something like this, our client services department can walk you through how documents are structured, titled, so that you can do this type of transaction, because we can help you with that. Okay, now I want to cover our full service approach. What we do for you is set up that retirement account LLC structure. We offer you that protected checkbook control. We have CPAs and attorneys available to answer your technical questions. We offer unlimited guidance on transaction compliance. We have a wonderful client services department. We handle all of the back office administrative support that has to be done. Detailed financial statements have to be maintained. Regulatory reporting must be completed, annual valuations made. So we will accommodate all of those functions, really administer your account fully so that you can focus on finding the best investments for your retirement account. So that's really your function as the investment manager, and we'll do all the back office paperwork stuff for you. So how can we serve you? You might want to open a self-directed account now that you know a little bit more about it. Maybe you have clients or colleagues who'd be interested in self-direction, or you just need more information. Please do get in touch with us. Our website, FTC IRA, has a great deal of information. Our corporate number is there if you'd like to call them and chat with someone. You can also email me directly at jknight@ftcira.com. We would very much like to help you if you're interested in self-directing some or all of your retirement funds. Now, I am going to open the floor for questions. So if you haven't typed your question in yet, please do so. Click next to the word question, the little arrow, and a drop-down box will appear for you. And I will open up mine so I can see those. And I did get a few questions beforehand as well. Okay. Can I purchase a property with funds in my retirement account and then sell that property and hold the mortgage for the new buyer in my account? Very good question. Yes, actually, yes, you can, as long as that buyer is not a disqualified person. So that would be ascendant, descendant, spouse, any entity that you're a majority shareholder of. So as long as it's not a disqualified person, yes, you absolutely could do that. And then you would set the terms of this loan with the buyer. Can my retirement account purchase additional interest in a property I'm already invested in? Unfortunately, the answer to that is no, because you are personally invested in it and you are a disqualified person to your retirement account. So you could not do that. In a new investment, you can partner, but not something you're already invested in. Can you give me some ideas for possible investments for smaller accounts? Well, tax liens, those are generally They can earn good interest rates. Private notes. Sometimes you can be an investor in a syndicate and have a smaller investment, but participate in the earnings of that syndication. Can I use funds from my retirement account to purchase a franchise? You would have to check with the franchisor to see if they permit retirement account investors. If you were permitted to from their end, you would have to remember that you personally could not be active in running the franchise in any fashion. It has to be a completely passive investment because you are a disqualified person to this franchise that your retirement account owns. Okay, so this is talking about moving money between accounts. I own several traditional IRA accounts and have money in a former employer's 401k. Can I roll over part of the money into a new self-directed account and then later in the year roll over additional monies? Okay, well, first I want to define the term rollover because there are limitations on rollovers. A rollover is when you direct the company that holds your retirement funds to send you a check, and then you put that money into a qualified retirement account within 60 days. That's a rollover. And there are limitations on doing rollovers. A 60-day rollover can be done one time per year for all of your accounts in aggregate. But again, it means the money was distributed to the IRA owner and then deposited into a retirement account within 60 days. Now, transfers are different. Custodial transfers means the money is going from one custodian to another custodian. And there is no limitation on that. You can do as many transfer of funds, custodian to custodian, as there's no limit on that, like there is the 60-day rollover. Okay, and let me see what I have here. How are taxes calculated on assets that are converted to a Roth account? Again, check with your tax advisor, but taxes must be paid. So this is on assets. So perhaps this is a piece of property or something that you're moving instead of cash. Taxes must be paid on the market value of the account assets as of the date of the conversion and at your ordinary income tax rate. So your tax advisor can assist you with that. I have money in my account that is idle from time to time for long but indefinite periods. I would like to earn a return by buying short-term instruments that will earn more than the bank interest rate. Options? Well, you can certainly get a brokerage account in your retirement account that you could then do whatever kind of investing in that kind of brokerage account you wanted to. It would have to be a business brokerage account in the name of your IRA LLC, and we would want to see statements from that brokerage account because we would need to verify that you weren't putting money in personally or taking money out personally because it is it's owned by your retirement account. So the money has to flow through your retirement account into the brokerage account, liquidate something in the brokerage account, it goes back to your retirement account, and then if you want to take a distribution, you can do that. Okay, looking at my time. Okay, I am out of time. Thank you so much for joining me. If you do think of additional questions, please feel free to call our corporate office or email me directly, and we will be happy to assist you. Thank you so much for joining me this evening. I hope you'll join me on a future webinar. Have a good night.